Good morning. I'm Sabrina Lowell, Advisor and Chief Operating Officer of Mosaic Financial Partners, and welcome to our webinar, Understanding the Affordable Care Act, or ACA. Before I introduce our speaker, Jim Holt, a few housekeeping items. We'll be spending the next 60 minutes together. Jim will start off with prepared remarks, followed by time for Q&A. Given that all attendees are on mute during the call, please type your questions into the questions box on your GoToWebinar. Throughout the presentation, we will have a chance to ask those questions while Jim is talking. Today's webinar is being recorded, so if you have friends, family members, or colleagues who weren't able to attend, we will have the presentation available on our website. At Mosaic, medical coverage is an important piece of a comprehensive financial plan. So we've partnered with Jim to help navigate this complex landscape and get proper coverage in place for many of our clients. And now I'd like to introduce Jim Holt. He's both a registered health underwriter and employee benefits consultant. Jim has nearly 30 years of experience in the insurance industry and works with individuals, the self-employed, and small business owners on getting the proper health insurance in place. He also specializes in Medicare and Medigap planning. So now please help me in welcoming Jim Holt.
Well, thank you, Sabrina.
Thank you.
It's been a fairly turbulent last few weeks. There's a lot of confusion in the marketplace right now with the Affordable Care Act, which is known as Obamacare. There's a lot of information in the news, and one of the problems is there's a lot of probably inaccurate information or incomplete information. So you're finding that a lot of people might get some information, but they're lacking the information. Some of it's not complete in terms of what you need to understand. Another thing that affects us in California is the healthcare.gov, the federal website, is they're the ones having a lot of the significant problems, where Cover California, the state exchange, is running much more efficiently. So you don't really need to use healthcare.gov in California. Just go to covercalifornia.com.
Good. Well, we look forward to hearing more about that during your presentation.
Right. So.
Thank you.
Okay.
You're good.
I'm off. So I'm going to talk about the Affordable Care Act from November 2013. Actually, it was signed March 23rd, 2010. But that's going to be an important day. We're going to talk about grandfathering, non-grandfathering, and a bunch of the terminology that we'll get into. And a couple of the concerns people are going to have is they heard Obama speak last week about extending medical plans another year, and so we'll talk about that also some in terms of what's going to happen there, if that's going to happen. So we'll go through some of the details of Affordable Care Act, and we'll get into, and I'll put in information that I think appropriate will be helpful to figure out right now. So the biggest thing, there's a new terminology that many of you heard now. It's called grandfathering versus non-grandfathered. Many of you have gotten letters from your carriers if you're on an individual plan saying you're on a non-grandfathered plan and your plan's going to terminate December 31st. And so that's basically non-grandfathered plans or plans that went into existence after March 23rd, 2010. All those plans are not compliant with ACA, don't have some of the mandated benefits, they're not at the metallic level, so those plans have to be upgraded to new plans as of January 1st. That may change if they extend the
One moment. Can everybody make sure that their phones are on mute on their end, please?
Is everything okay? Okay. So if you're on a non-grandfather plan, your plan is being migrated to new plans as of January 1st or later in the year. If you're on a grandfather plan, that means you're on a plan that was before March 23, 2010. That was when the bill was signed, and you're not required to change your plan. For most people, that's not always true. There are people who are on grandfather plans that are being forced to change to new plans next year. It's kind of actually it's kind of a carrier election. It's not so much your election as an individual. So you may be said, I was on a plan. I have not changed my plan since Obamacare was signed, but I'm now being forced on a new plan. And that's really a carrier election where they've opted not to continue on their grandfather plans as of next year. So So we're going to talk about some of the changes in 2014. There was a lot of, good feel-good things that happened with ACA. Prior to that, you could keep your kids on the coverage until they turned 26. They extended benefits to life unlimited benefits on all plans. They've been added preventive benefits to the plan. So there's been a lot of feel-good things before now, but a lot of the major changes in ACA were happening 2014, January 2014. So we'll talk about the changes. One of them is Cover California is coming into existence. There's been a lot of advertising regarding that. You've probably seen a lot of ads on TV or on the radio about it. There's a big, spending millions of dollars just to push what Cover California is, and we'll talk more about Cover California. We'll talk about metallic plans, which are the new plan designs, platinum, gold, silver, and bronze. Essential health benefits are the new benefits that all plans have to have embedded into their program as of January next year. Some people are going to qualify for federal tax credits and subsidized plans. There's been changes where everything's guarantee issue. You can't be declined due to health issues anymore. They've changed how they calculate rates, which have a lot of impacts on individuals. There's the individual mandate where everybody's going to be required to provide carry coverage, or they'll pay a tax. They have a tax penalty, and that's maybe delayed. There's been talk about delaying it, but we'll see what happens there. And there's a couple of new taxes and fees that are being passed on to carriers, which will actually be passed on to individual plans and group plans that also impact rates. The first thing is, what is Cover California? That's most people have probably heard of it today. What Cover California really is, it's a state agency that implements ACA in California. So basically, it's just a new government agency that's been created, and they take care of implementing ACA in California. It's also a marketplace to buy coverage. People, I think, are thinking that they have to buy a plan through Cover California. That's not correct. Cover California is just an umbrella. I kind of equate them to like a big Walmart. And you go to Walmart and you put your application in, and they tell you if you qualify for federal tax credits or not, and then they send you to a Kaiser kiosk or an Anthem kiosk or a Blue Shield kiosk to buy your coverage. But if you don't qualify for tax credits, and we'll talk about what the qualifications are a little later, you can actually just go to Blue Shield or Kaiser down the road directly and sign up with them. So Cover California is not there for everybody. If you don't need to deal with Cover California, it's probably simpler to go directly to the carriers. Another thing about Cover California is that if you qualify for federal tax credits, you have to buy the coverage through the Cover California umbrella. You can't go directly to Kaiser or Anthem with your tax credit and apply for it. They won't give you the tax credit. It has to be through the umbrella of Cover California. And so Cover California's web address is www.coveredca.com.
Now, Jim, we've heard a lot of confusion or people going on to the national ACA website and having difficulties. How is Cover California's website maybe compared to the national website in terms of being able to navigate and get coverage in place?
From my understanding, it's much more functional. I mean, you can actually open up an app. You can create an account. You can start the application process online. You can look at your plans. You don't have to create an account ahead of time to look at plans. I think the federal website, you have to create an account before you can even look at what's there. California, you can just look at the plans without having to create an account. So they're actually much more down the road. There are still some glitches internally. They can't tell brokers when if someone's nominating me as a broker, because I'm a certified agent with Cover California. But if someone nominates me, there's no mechanism they have to tell me that. So little things like that are going on, but we're in far better shape than the federal website. We're lucky we're here in California.
Great.
One of the new changes that's coming on board now is the metallic plans, and those are platinum, gold, silver, and bronze. This means the platinum plan has to pay at least 90% of an actuarial value. This means it's really the richest of all the plans. Don't get confused by the 90%. It just doesn't make sense to most people. It's hard to explain. So that's the richest plan. It has the most comprehensive benefits, and it's the most expensive. And gold is the second richest, silver, and bronze. And the reason why they've come out with metallic plans is they're trying to standardize plans. I mean, as a broker, one problem I've always had is some carriers might have 30, 40 different plan designs, and you multiply that by several carriers, and multiply that versus group versus individual, a very confusing marketplace. So they tried to make things simpler, and their solution was to come up with the metallic levels. And so all new plans starting January 1st have to be bronze, silver, gold, or platinum. There is a catastrophic plan that's available to kids that are age 30 and under, and so they can sign up for it, but most people do not qualify for catastrophic unless they can demonstrate some kind of financial hardship, then they may be able to sign up for that catastrophic plan. Another thing that's included in all plans starting January is what are called essential health benefits. And most plans have already had most of these services embedded in them, but they've enhanced some of the benefits. So they have like ambulatory care, emergency services, hospitalization, maternity, mental health, RX drugs, and all that. Those are all included in the new plans. A couple areas that are enhanced, like mental health services, you probably find that you have more benefits in mental health services now than you've had in the past. So it's probably an upgrade in benefits. The plans have always covered mental health, but they've always been kind of a limited benefit by a lot of carriers, and so those benefits will be enhanced. There have rehab and habilitative services. Habilitative services are new. Those are like for functionality. If you need, like you have like an autistic kid and they need, work with somebody to enhance their learning and all that. Those kind of services will be covered now under essential health benefits. And the other new benefit that actually is out there is for pediatric dental and vision. And what that is all kids 18 and under are going to be required to have dental and vision services built into their plan. So it doesn't apply to adults. If you're an adult, you don't get the dental or the vision, but the kids 18 and under will have pediatric vision and dental built into the plan. So whether it's platinum, gold, or silver, or bronze.
Now, Jim, does this apply to both group plans through an employer, large group plans, and individual plans?
This will apply mainly to individual plans and small group plans, which is defined right now as groups of 50 and under. So it doesn't apply to large companies, doesn't apply to Medicare. This is mainly most of the effects that are going on today are really in the individual marketplace and also in the small group marketplace. Another thing that's being added starting January is that people can qualify for federal tax credits. If your income is low enough, you will qualify for amount of credits. It's a sliding scale. The lower your income is, the more tax credits you may qualify for. And also, they also have some enhanced benefits, which are only at the silver level. So if you qualify for enhanced benefits, which means your earned income is below 250% of the federal poverty line, you will qualify for enhancement, which means that there's a lower deductible and there's lower co-pays on the plans than the regular silver plans. So it's actually a pretty good deal. And there's also the small business tax credit that's available to businesses that have less than 25 employees. So we'll talk more about that. So the small business tax credit, okay, we went through one slide. So this is for the individual guidelines of if you're below 138% of the federal poverty line as an individual, you'll qualify for Medi-Cal. So anybody who's under 138% of the poverty line gets Medi-Cal. They've expanded it here in California. Some states, they have not expanded Medicaid. And so if you're really poor, in some states, you get nothing. So if you don't get tax credits, you just get nothing. But in California, if you're below that 138% poverty line, then you qualify for Medi-Cal. And it depends on how many people in your household. So if you got one person in your household, your income is under $15,856. If you have 4 people in your household, your family income has to be below $32,499. Between the 138% and the 400% is where you qualify for the federal tax credits. So if you're a single person and your income is below $45,960, you'll qualify for some tax credits. If you're below the 250% number, then you get those enhanced benefits I was talking about earlier. So they basically allow you to have a richer plan. So they've decided silver is one. So that's a good play. You might qualify for you might find a bronze plan is going to be cheaper to buy, but you will find that because of the enhanced benefits, for most people, if they qualify, they're better off taking the silver with enhanced benefits than taking a lower cost bronze, because the bronze does not have the enhanced benefits. One thing when you apply to Cover California, they're going to ask you, they ask a bunch of financial questions. The application actually is pretty long because of the financial information they want. And they look at household income. They look at everybody who's on the tax return, they're going to look at. So if you've got 4 people on the tax returns, they're going to want to know the household income of everybody on that tax return. You know, wife, kids, and all that. So that's how they determine what you qualify for. And they run your numbers by the IRS. So if your income is within 10% of the IRS showed for 2012, they'll accept it. If you're outside that 10% parameter, they're actually going to want some additional information. So it's a fairly cumbersome process. So if you're outside the 400, if you're above that 400% poverty line, it's just far simpler to go directly to a carrier and bypass Cover California altogether, in my opinion. The small business tax credit, that applies to businesses that have less than 25 employees. The average income of the employees has to be less than $50,000. They will qualify for a tax credit up to 50%. It has been 35% was the max, but that's changing as of January 2014. But the one change that's big is in the future, to get the tax credit, you have to buy your plan through the Cover California to get that federal credit. Right now, it's whoever your carrier, doesn't matter. There is no Cover California pass, so you just got, if you qualified, you just got the tax credit. But if you want to continue to get the tax credit, you have to move your plan through Cover California and their product line and all that to continue on. And that starts January 1st. So if you wait until July 1st, you only get like a half year credit. So if you want the full year credit, you need to move your plan as of January 1st. And I've had a couple of clients who've looked at going to Cover California because they have qualified for the tax credit, and they have to make a decision if they want to continue that tax credit, because the plans are different in Cover California, the networks are different, and so there's a lot of factors to go into deciding if you want to continue on that tax credit. So that's kind of a big decision the business owner has to make. Another change that are happening is, and probably most people are aware of it, there is no more medical underwriting on individual plans or small group plans for that matter. So there's no more health questions. The bane for me is when you get an application, people have to fill out this really thick application and answer a lot of health questions. There will be no more health questions on the application. So that makes the application process far quicker and far simpler because that's going away. You can't be declined by a carrier. There's nothing to decline you unless you're not a U.S. citizen or not here legally. If you're here illegally, ACA doesn't apply to you because you can't sign up for the plans if you're not here legally. And also the carriers can't rate you up anymore either. So sometimes if you had high blood pressure and were on a medication for that, and you had a little bit of high cholesterol in your medication for that, they might say, we'll take you if we can charge you 25% more. That all goes away. So the rates are going to be just one set of rates. It can't be anything different due to your health and your past history. You can't look at genetics, any of that kind of stuff. Pre-existing conditions go away, so if you sign up for the plan, any pre-existing you've had, that's fully covered. So all that's changing, which is a good thing for a lot of people. I've had a lot of clients who they thought they were pretty healthy, and they've actually signed up, fill out the application, the carrier comes back and turns them down. And it's not because they're unhealthy, it's because they have maybe several small things that we get as we get older, and the carriers looked at it as a problem, and so they've declined people or rated the club. So that will make life a lot simpler for people applying for individual coverage. The other change that's happening, and this actually affects individuals and individuals on small business plans under 50, is they're going to change the way they determine rates. Going into the future, they only can base rates only on 3 things starting next year. It's going to be your age, where you live, your zip code, and how many dependents you have on the plan. Those are the only 3 factors they'll look at. Smoking is not a factor in California. In the federal law, smoking, people could be rated up 50%, but California decided not to do that, so smoking is not an issue at all in California. So basically, age, zip code, and dependents is only 3 things that affect your rates. Another thing that does affect the rates, though, is there has been something called rate compression. And what that means is that the rates for someone who's, say, 21 has to be within a 3-to-1 ratio, say someone who's 64. So right now, the rates have probably a 6-to-1, 7-to-1 ratio of youngest to older people. Now that can be no more than 3-to-1. So if a 64-year-old's rate's $600, the 20 to 21-year-old's rates are going to be $200. So what that really ultimately means is rates will probably not go down much for people who are older. The people who see more rate increases are actually probably the younger age people, because for the carriers to get into that 200 ratio, they're bringing the young people's rates up to get to that ratio. So you're going to find a lot of people who are younger probably are unhappy because they've seen a big rate increase, and they're trying to get those people into to buy coverage. That's to make everything work. They want the young, healthy people to sign up as well as the older, sicker people that are coming into the system. So, but the problem is, one problem I see is that the rates for younger people have gone up significantly.
So Jim, it sounds like rates are going to come up for younger people with this price compression notion. And we had a question that relates to that, I think, and it talks about the underwriting process. You mentioned that there will no longer be health underwriting. So even people with chronic illness or terminal illness must be accepted by every plan. So how is that? Talk a little bit more about how that will work and really what you think that the effects of that will be.
Right. Well, there will be no more underwriting. So the carrier won't even know you do have a chronic condition. I mean, because it's not on the application. There will be no health questions at all on the application. So you basically are signing up, and the carrier has to take you the way you are. So when you get approved, they have to cover your pre-existing from day one when you're on their plan. So that's probably the biggest difference. So if you got something major going on, you can get coverage. If it was very difficult in the old system, there were some guarantee issue plans that were very expensive. Those are going to go away because we don't need those anymore. So yeah, definitely. But the younger people are going to be not happy with the ACA because their rates are probably going up more than most people.
So that's the community that will really feel it the most, or the most price change based on ACA.
Right. Exactly. And it really varies from state. In California, we're kind of in the middle there. Some states, the rates were very high. Like New York would be an example. The rates are very high. It's very highly regulated. Most people in New York, their rates are probably going to go down because of that. There are other states like Iowa where the rates were really low, and they're going to probably have bigger rate increases in California. We're kind of in the middle, actually. So if you have relatives or dependents in other states, what's going on there can be completely different in California. So it's really varied by state to state. An example of the rating changes that are happening is, in the past, this is not a typical family. They got 4 kids. It's probably not quite typical, but you got a husband who's 57, his wife is 52, and they have 4 kids, ages 23 down to 14. Under the old way rates are done, this is true for individual plans and true for small group plans, is the rates usually are based on the younger spouse, at least in individual markets. So if your wife is 52, she would be the primary person, the rates would be based on her age, and the older husband wasn't penalized, and it's at a flat family rate. Didn't matter if you had 1 kid or 4 kids, the rate was the same. So, but now what's going to happen going forward is the rate's going to be based on the age of each person on the plan. So they're going to look at the age of the spouse, but they're going to look at the age of the husband and the ages of the kids 20 and under. So the first 3 kids for kids that are 20 and under will have the same rate. So there'll be a rate times 3 for the 19, 17, 14-year-old, but they also can charge for any kids that are ages 21 to 26. So they can, in this case, they're going to get charged for all 4 kids. And so their rate's going to probably go up significantly from what they've been paying. If they were on a family plan, this family is going to be unduly affected negatively. Their rate's going to go up quite a bit. I have an example. I have a client. He's on a small business plan. His wife is several years younger than he is, and she's actually the employee, and he's a dependent on hers, and they have 12 kids. And they have kids that are under 20. They have kids that are between 20 and 26. And their rate, which is about $1,300 a month before, is going to go to $3,700 because of the new rate structure, just because of the age, them being older and then a lot of kids. That's the extreme. But for someone who's got 3 or 4 kids, you're going to probably find your rates are going to go up if you're on an individual plan. But if you also work for a small employer, when the renewal of that group comes up, that's when these changes happen for a small group plan. So if your small business plan renews, say, July 1st, all these changes will happen July 1st to this plan, and so all of a sudden the rates will change based on the new rating structure at that time.
And Jim, you talked a little bit about children up to age 26. So for those who may have adult children who are technically still dependents or maybe getting a master's or a PhD where they have low income and have been traditionally on a family plan where the rating will change, might they be appropriate to pursue an individual plan going directly through the exchange and then perhaps even qualifying for the tax credit with low income?
Right. They need to look at that. The factor is if the child is on their tax return. If the child is on their tax return, the child can't apply for federal tax credits. If the child is filing taxes on their own, then they can qualify based on their income alone. So it really has to do with how the tax tends to go up on the tax return. So that's just an additional factor to kind of throw in there now. So sometimes it may be an advantage to having the kid go off on their own plan and get the federal tax credits. And actually, it might even help the family. It depends on what their income levels and all that. So
that's really a planning opportunity where you are in that mid-20s range, pursuing the possibility of going off as a dependent, or if they are already not qualifying as a dependent but low income due to their either financial situation or that they may be pursuing an education, looking at.
Right. They may be working a little bit. They may make $5,000 or $10,000 just to get by, but they may it may be to the advantage to actually file as a single person. They may get enough credit to where it actually makes sense to do it that way. So you need to evaluate with your financial advisor if it makes sense or not. So. Also, one of the new things, there's going to be an individual mandate penalty, which starts next year, which, I think this has been a very controversial area where a lot of people have been opposed to it because you're being required to provide individual coverage. If you don't, you get penalized. The penalty next year is not that great. It's either $95 or 1% of your income, the greater of the two. So that's not going to be, that's not going to be a big barrier to not sign up if you only have to pay $95. If you had to pay an extra $150 a month cost, like I have my example, I have a daughter who's 28. She doesn't have coverage. She prefers to spend her money on concerts or something like that than buy health insurance. So if she had to spend $150 on a health plan or could pay a $95 penalty, she'd probably be better off paying the $95 penalty as far as she's concerned. And that's going to increase. So starting in 2015. It's going to go up to $325 or 2% of your income, and year 2016, it's going to be the greater of $695 or 2.5% of your income. So then it'll be a cost of living adjustments from there on out. And if you don't provide coverage for your kids, you pay half of the numbers above. So
now, Jim, how are they going to enforce this? It doesn't seem like it would be easy. So how will that be enforced?
That's the question I don't have the answer to. I think the IRS is going to have to come up with some way some kind of form and something you indicate on your tax returns that you have covered. So I haven't heard what the mechanism will be to enforce that. That's going to be a good question. But they will come up with a way to do that. So there's a number of issues that are kind of still unclear. That's the thing. There's a lot of information out there, but there's also a lot of missing information, and that's a perfect example of how they're going to enforce that. And there's talk in the Congress of maybe for the next 2014, with all the problems they're having at the federal level and with enrollment and all that, maybe postponing it a year. I don't think that's going to happen, but who knows in today's environment. And if you have a hardship, there's actually exceptions where you don't have to pay that penalty. You can file for hardship and avoid that tax penalty too. So, okay. There we go. There's two new taxes that are affecting plans starting January. These are both being passed on to the carrier, but the carrier is going to be generous and pass through to the people who are on the plans. There's a health insurance tax, and this is actually the way the government is funding all these tax credits that people are going to qualify for on the individual marketplace, is they're taxing all the carriers based on the premium that they have for health insurance. And that's estimated to be about 2.3% of cost. So that's going to be a one pass-through. So if you qualify for the tax credit, that's where the money's coming from. The government has to generate, revenue to take care of that. So, and the other thing there, another tax that's happening is the reinsurance tax. So that's one carrier, if they get an abnormal number of people who are unhealthy and they have a bad claims experience, there's going to be a mechanism for them to be reimbursed for that. So it's a way they're passed on a risk based up to the different carriers based on what they're finding their enrollment has been and what their claims experience has been. So if a carrier has an abnormal amount of claims because they've had more people than everybody else sign up for unhealthy plans, they'll get a larger pool, reimbursement of that pool. But the second one, the reinsurance tax, is going to be phased out by 2016, so that's only for a couple of years. But the health insurance tax one will actually be there for quite a while. I know there's also been talk about trying to repeal those two taxes, but again, that's something I don't think is going to happen. That's the linchpin of the tax credit. If you repeal that 2.3% or delay it a year, where's the money going to come from for the tax credit? So it's all kind of linked together. So you just can't, if you try to take away one part temporarily, it affects other parts of the plan. That's the whole issue is going on. Even for the 1-year extension that Obama is talking about, that you can maybe keep your group plan the next year, because a lot of people have received their notices that their plan is ending December 31st of 2013, and they're going to be forced onto a new plan. The solution was to allow carriers to extend that for a year, that they could stay on the plan and one more year longer. But what that affects is all the carriers, when they price out their new plan, they're assuming all these people are coming into the risk pools. And so all of a sudden, if these people can stay on their old plan, it changes the people in the risk pool for the new plans. And so it adversely affects the rates probably in 2015. So it is each piece you modify has an adverse effect on the overall program.
So, Jim, talk just a little bit about so the taxes that you have up here. It does equate to about 3.8%. So, at minimum, we're looking at a 3.8% increase for premiums going into next year. But really, what are you seeing in terms of rate increases? We've heard of plans or clients who are maybe larger group plans, or perhaps it's a 50 and under, so it's a small business plan, but it is a business plan, where they're getting notices that they're looking at 50 to 60% increases. What does that do to, and kind of talk a little bit about that landscape?
Okay. Well, these two taxes are just part of that increase. I mean, this increase is going to go to apply to all plans. It's already built into the rates that are going for 2014. But a lot depends on what kind of plan you are on currently. There are a lot of people who are on scaled-down plans that are far below the bronze level, if you want to call it that 60% level. So the people who are on more skeletal plans and maybe don't have a lot of benefits and they're cheaper for that reason, those plans have to be brought up to at least the 60% level. And so those people who are on scaled-down plans are probably seeing bigger increases because they're getting offered the bronze plan that's quite a bit richer than what they have, and so they're probably seeing big rate increases due to that. And it also comes back to where, based on your family structure, if you had 3 or 4 kids, you might find all of a sudden the new plans are based on the new rating system, and so you might, if you're on a scaled down plan and had quite a few kids, then you might have a pretty big size increase. You might find a 50, 60, 70% rate increase due to that. So it's a kind of a complicated question. It has a lot to do with what plan you're taking on currently.
Well, and speaking of that, we had a question that relates to that, and that is, it seems a bit confusing. I mean, there's a lot of information here. So people can go to the website and go through the exchange, but ultimately if they don't qualify for tax credits, they'll be directed towards going directly to a Blue Shield or a Kaiser, right? So you're already going direct there, but is that really the best route, or is it easier to use a medical insurance broker, or how will people navigate this landscape?
Well, if you work with an insurance broker, I mean, I will work with all the carriers, both in the exchange and outside the exchange, so you'll get probably a more comprehensive view of the landscape if you work with a professional that does this for a living. If you call a carrier, they're only going to be able to comment on their plan, and depends on the person you talk to how much they actually know. I mean, the problem I have as a broker is you get to talk to people who don't know much, or they're new and all that. So if you really want a view of the landscape, a broker will help you. like my quoting system, I can quote cover California plans, but I also, like Anthem and Kaiser have plans that are outside of cover California. They have to be one of those 4 metallic levels, but it's a different plan design and maybe different deductible, different co-pays. So there are plans that aren't in cover California that I have access to that I can quote. So cover California, if you're going to qualify for federal tax credits, you have to go to cover tax. It's a requirement, and so you're going to have to pick one of the plans for that carrier. But what I'm saying is, if you know you're not going to qualify for federal tax credit, you know your income is too high, you better off just going directly to a carrier when applying. And you can actually use Cover California to look at the plans that they sell, and by law, the carriers have to sell those plans also outside. Identical plans, identical rates, identical networks. So you can buy the exact same plan that you see in Cover California directly with the carrier. You don't have to use the Cover California, umbrella. But also there are some plan designs that are separate that you also can apply for also.
So the pricing will be the same whether you go through the exchange or direct to the carrier. It's just whether you're qualifying for tax credits.
Right. Yeah.
So I'm an individual. I don't apply or I don't qualify for tax credits. I should go directly to the carriers if I want help in navigating that process. Using a broker to help get a more comprehensive view may be the best way to go, unless I know that, for example, if I'm already on Blue Shield and I like Blue Shield, maybe I go direct to them.
Yeah, you can.
Okay.
Right. So you have the option. It's a lot of people who've taken out plans directly with carriers, and so they don't have a broker they're working with. You can do it, but again, you're limited by that one carrier. And one big change that's happening is on the individual marketplace, especially, is most of the carriers are coming out with smaller networks for their plans. So if you're on, say, a Blue Shield PPO, starting January 1st, all the new Blue Shield plans are using a smaller network of doctors. To get the cost down, the carriers have gone back to the providers and said, we want a bigger discount in essence. And some of the providers say yes and some say no. The ones that say yes are in the new network. The ones that say no are in the old network, but you don't have access to those doctors. They're out of network going forward. So that's one of the big changes, and that's one thing that's really confusing is the provider networks, and they're still trying to build their provider network. So you'll find that if your doctor isn't in the network, he might be in the future. He may contract, or you may call your doctor, and he may not know if he's in network or not. That's a common problem. So
when will there be more clarity on networks? You were indicating maybe a timeline of January, so I take it that those are under negotiation right now?
Yeah, right. So the carriers are building their network. So right now, I know, like with Anthem and Blue Shield, their networks are probably 50 to 60% of the doctors that are in their bigger networks. So when you go into the new product, you're going to get a smaller network, and your doctor may be out of network all of a sudden. So, some doctors are just not going to agree to a bigger discount, and as a business person, that's their choice. So. And
for large group plans, are networks staying roughly the same, or do you see those networks changing as well?
They're probably staying the same. The smaller networks, some are already out there, actually. Some of the large groups you have, if you want to get your pricing down, you can actually contract with a smaller network of providers. There's HMOs, and then there may be a couple subsets of those providers that have lower pricing. So if you want a medical plan that costs a little less, has the same benefits, you go to one of those plans that has a smaller network. That's just one way to get pricing down. If you want maximum flexibility, you go with the plan that's got the full network, but it's probably going to cost you a little bit more to do that. So that's one thing that's frustrating for people who are being moved to the new plans. They're going to be forced from their bigger network to the smaller networks when January rolls around. Depends on the carrier you're with also. I was going to talk about, this is what I know about what's going on with various carriers in terms of, and what happens to your plan. It really depends on, again, if you're a grandfather versus non-grandfathered. If you're a grandfather plan, you may get a letter from your carrier saying you don't have to do anything at all. Your plan will stay the same. Your rates may go up, but it's going to be based on the experience of the pool that you're in for the plan you're on. And if you're on a non-grandfather plan, you're being forced to move into one of the new metallic plans in January. And so it also depends if you're on individual or group, because all these changes are really happening to individual and small businesses. So whether you see it now, if you work for a small employer, you may not see it until your plan renews, and maybe in July, it could be next September, whenever. So that's when those changes will happen. And all the talk I see in the press is all about individual plans. There's no talk that the same thing is actually happening to small group plans too. They're being forced to terminate their non-grandfather plans at renewal, and they're going to be put on a new metallic plan. So if you have a renewal date of January 1st, all these changes are happening January 1st, and I haven't seen any talk that small group carriers are going to change what they're doing. So we'll see what happens with that, because that's actually an issue out there too. Regarding carriers, this is mainly regarding individual plans. Aetna is in California, but they're leaving California January 1st. So if you had an Aetna individual plan, you probably got a letter from Aetna a few months ago that they're withdrawing from California, and you need to find a new carrier as of January 1st. They're a big multi-state carrier, and they've opted. California is not one of their main states where they're competitive in, so they've opted to withdraw from California. So all my Aetna clients have to move to another carrier January 1st. And I don't think that's going to, even if they do the one-year extension, I don't think Aetna is going to stay in California. So I think they're going to be gone. So if you're with Anthem, they have grandfather plans and non-grandfather plans. If you're on a grandfather plan, you can keep your plan at your current rate until they change it. If you're a non-grandfather client, you're going to get one of the new plans January 1st. There's a few people who got late notices, and they may have an extension until February 28th to keep their non-grandfather plan, but that's a very small piece. Blue Shield did the same thing as Anthem. They have grandfather plans and non-grandfather plans. If you have a grandfather Blue Shield plan, you can keep it at the current rate. If you're on a non-grandfather plan, you're going to be migrated to a new plan January 1st, except they're required by the Department of Insurance to extend that until March 31st, so you might be able to keep your non-grandfather plan 3 months longer. Because you have to make an election to do that. You need to contact them by December 6th. That's their drop dead date to make changes. Health Net has grandfather plans and non-grandfather plans. They've elected to terminate all their plans and move them to new plans. So if you're on a grandfather plan with Health Net, you're going to be forced under a new plan January 1st. They've just made a business decision. They don't want to continue on with grandfather plans. So unless the changes for what's going on with the Obama and extended a year. Kaiser basically doing the same thing as Blue Shield and Anthem. They have non-grandfather plans and grandfather plans. If you have a grandfather plan, you can keep it at the current rate. Otherwise, you're being moved to a new metallic plan. So that's kind of what's going on in individual. I won't talk about group stuff at this point, but that's if you're on individual plan, that's, to my best knowledge, of what's going on with all those plans.
So, Jim, you talked a little bit about Aetna is exiting the California market, but they will continue to remain an insurance carrier. And a question was coming in about United Healthcare, which isn't listed up here. This question is actually from Arizona. I'm assuming United Healthcare isn't offering the ACA plan, an ACA plan option within California, but talk a little bit about United Healthcare relative to some of these other.
That's a good question. United Healthcare in California does not do individual business. They're only in the group marketplace. So if you're not on a United Healthcare plan in California. Some states they do individual plans. So United Healthcare, they do small business, and they're known for their large company plans. So that's their main market. Another carrier that I didn't mention is Cigna. Also, they have individual plans, but they're not part of Cover California. So you can actually buy a Cigna plan for December 2013 and keep that plan for another year, but you do have to go through full underwriting to do that. You have to answer all the health questions because that's an underwritten plan. They also have plans that are coming out January 1st that will be the new metallic plans and with different pricing. They don't have to terminate their non-grandfather plans January 1st like everybody else because they're not part of Cover California. So they weren't required by Cover California to terminate individual plans at that date. A couple of the questions that have come up, and we've talked about a lot of this already, is who's most affected by ACA starting January? Really, the people that are affected most by it are individuals that are under 65, if they're on individual plans, or if you work for a small company under 50 employees, because those people are all required to be compliant with ACA starting in January or at the renewal date. People who are on Medicare are not affected by what's going on. If you're on a Medicare supplement, you're not affected. If you're on Medicare Advantage, you're not affected. If you're on a Medicare Part D plan, you're not affected. So those people don't have to worry about it at all. And the other people who really aren't affected much by it also are people who work for large companies over 50 employees. They don't have to do these metallic plans and all that. And so most of those plans are pretty rich in benefits. And there's something called pay or play, where large companies were going to be mandated to provide benefits to their employees. That was pushed back until January 2015. So we won't talk about that right now. So it's mainly the individual marketplace and the small business marketplace are the two areas that are really affected. And that's my core business. My workload has gone up exponentially since this all happened last month and a half.
So Jim, you mentioned that this doesn't apply to people who are on Medicare, so post-65. We did get a question coming in about how does this work with, or AARP, and do they work with a particular insurance company? Well,
they do. AARP, they're not an insurance company. Like in the individual marketplace, they use Aetna as their individual carrier, which obviously that's changed, and so with Aetna pulling out. And United Health, AARP has pulled their plan a few months ago with Aetna because Aetna was pulling out of the marketplace anyways. But United Healthcare is available through AARP on Medicare supplement. So it really depends on what product it is. So in California, you can get a Medicare supplement with United Healthcare, but you can't get an individual plan under 65. So it really depends on what marketplace you're at.
So the AARP under 65, if they were previously offering coverage through Aetna, they may be coming out with a new carrier.
Right, or I don't know what they're doing regarding that. I haven't heard what AARP is doing. So obviously the people that are on Aetna, their plans are also ending December 31st. So anybody, whether it's AARP or Aetna Direct, all plans are going to go away end of the year.
So if they're going away at the end of the year, which we're rapidly approaching, when will people on those plans have more clarity about what their options are, or what action should they be taking now to make sure that that they have continuous coverage going into the new year?
So one thing that's happening, Obama mentioned last week that people could keep their plan an extra year to December 31st, 2014. That's actually a state decision and a carrier decision. So in California, I just read this morning that decision is going to be made tomorrow by basically between Department of Insurance and the regulators in Cover California. They have to come to a conclusion of what they're going to do. I mean, Dave Jones, the insurance commissioner, he was in favor of extending it a year. I think Cover California is not that favor about extending it a year. What to decide, we'll hopefully know tomorrow or Friday. So then if they do decide to extend it a year, then you have to make that decision. You have to look at what your current plan is, what your current rate is, and versus what's out there January 1st. If you qualify for federal tax credits, you still may be better off moving to a new plan January 1st to get the tax credits. So you still have to evaluate what you're doing currently with what the new plan options are going to be to you. But you're not going to be forced off necessarily. The carriers they're migrating you to new plans. So a lot of people get the determination letter, but most of the carriers outside Aetna will have new plans, and you'll be moved to a new plan based on what they think is most comparable to what you've had. It may not look that comparable, maybe higher deductible, different co-pays, different out-of-pocket, but in their opinion, that's the most similar plan. So it's not like you're really losing your coverage. You're being moved to a new ACA compliant plan January 1st or maybe later.
And speaking of the premium differential and moving to these new plans that are the metallic plans, we have a number of carriers listed up here. So let's say that you have one of the bronze plans, for example. Is there a pricing differential between going to Blue Shield and Anthem if you're on that bronze plan?
There is some pricing difference, but not a lot. You're going to find there's a lot more conformity. The rates are a lot closer now than they've been in the past because if you're a bronze plan, you have to cover actually 6% of claims. And so all the carriers have to all do that with their bronze plan. And so the pricing actually is, there's some difference, but it's not as big as it used to be. There were so many different plan designs in the past that there's a huge range of pricing differences. Now there's much more close conformity to what for each metallic level. So and even Kaiser, one issue that Kaiser has is they can't recontract with themselves to have a smaller network. So Kaiser actually looks more comparable to everybody else cost-wise now than they've been in the past. Their plan designs are a little different because they're an HMO, But you even find even the cost difference between Kaiser and the competitors is much closer because a bronze Kaiser has to cover the same thing as a bronze Blue Shield or a bronze, Anthem. So
as a consumer, as an individual, if I'm looking for health care going forward, I'm going to have more clarity about what my plan covers based on the level of metallic level, and that's going to be the same across carriers. And what you're saying is the trend really is going to be that pricing is going to be more similar going forward than it has been in the past.
Right.
So then it really becomes more of a question of who my doctor, which network that they're in, and determining which carrier to go through based on my doctor and perhaps personal experience or bias towards one company versus another.
Yeah, I'd say I think there's going to be a lot more conformity pricing-wise. So yeah, it's going to come down to networks. You may pick a carrier based on your doctor being in a certain network versus somebody else. Also, the drug formularies are changing on the individual plan, so you need to check to make sure the drugs you're taking, especially if you're on like a specialty drug or an expensive brand drug, they may have been covered in the old plan and it may not be covered in your new plan, so you need to check the formularies also. So those are, I think, going to be two big driving factors: is the network and the formularies of the carriers, and then maybe the deciding factor which plan you actually go with.
I'm getting another question here coming in that asks, you mentioned the start date for January 1st, 2014, and the open enrollment process. So if people are making a switch to have a new plan start on January 1, when do they need to apply by?
Right now, if you want a January 1st effective date, most of the carriers want the applications by December 15th. So if you need to move, you need to have the application into them by the 15th. Now, there is open enrollment, so there's a 6-month window for open enrollment. It's basically from October 1st to March 31st. Because it's all brand new, they're giving people a lot of time to sign up for the plan. So you don't have to sign up January 1st, only if you want a January 1st effective date. If you want more time, this is all guaranteed, it's all available to you through March 31st. After March 31st, the only times you can sign up, there's going to be open enrollment once a year, which is going to be October 15th to December 7th. So if you don't sign up now when you're available, you have to wait till then to sign up. That way, people just can't sign up whenever they want to. You get adverse selection when you do that. It's also the same open enrollment as people on Medicare, actually. It's, for Part D and Medicare Advantage plans, October 15th to December 7th is open enrollment there also. So
if you need coverage effective January 1, applications should be in by December 15th. However, if you're on an existing plan and you're okay waiting a little bit longer to be able to make perhaps a more informed decision, there will be more information coming out about networks, so on and so forth. You can actually wait until March 31st to make that decision if you have coverage already in place.
Correct. And then also that's true for the individual mandate, too. That as long as you sign up for a plan by April 1st, that penalty that won't apply. So they've actually extended when you can sign up so you avoid the penalty at the same time.
And you're talking about these mandates on the individual coverage. Those do also apply to large corporate group plans. So the 50+, you're just indicating that because most large group plans are already relatively rich, i.e. providing what the metallic plans are requiring on the individual side, there's probably not going to be much of a change from the consumer standpoint.
Correct, yeah. As long as if your employer has a plan, it's probably they're not required to become one of the metallic levels. Now, if you're a large employer with 50, you're going to be required to provide coverage to your employees or potentially pay a tax. And for small business being 2 to 50, there is no mandate to provide health insurance to your employees. So if you have a small business, you're not required by the law to provide insurance at all. So there's other reasons why you provide insurance, but that one you're not mandated by the law to do that. Now, one change that's happening, if anybody who is, one way to get around coverage in the past was if you had insurability issues, and you had a small business, you would do like a husband and wife small group plan. That is going to go away starting next year. There's a new state law that the husband and wife plans cannot be a group plan. You have to have one W-2 employee that's not your spouse to create a group plan. So if you have an employee with on W-2 or a child on W-2, you can do it. But I have a number of husband and wives that we set up group plans by putting one of them on payroll or putting an S corp. That won't work starting January 1st going on.
So when do those individuals need to take action by? You said if they have roughly a year.
What do you mean in terms of?
So if if I am on a small group plan, me and my spouse, because we have a business, we've gotten health insurance as a group plan, the two of us, that'll no longer be effective going forward. When do I need to begin exploring my options or apply for new coverage?
Right. Well, you need to explore. I mean, the carriers, depends if your carrier is auditing their groups or not. I mean, if you're a husband and wife group and you don't get audited by the carrier, they may renew your plan. You might be fine. Some carriers may audit your group to see if you have any employees or not. If you don't, they may say you don't qualify to be a group anymore, and you'll have to go into individual marketplace. Now, one thing we did husband and wife groups on a guarantee basis because we didn't have guarantee issues. We had insurability issues. Now we have guarantee issues. So that's part of the rationale of not offering it to husband and wives, because they can get their coverage guaranteed to the individual marketplace now. So.
Now, what if I'm an individual anticipating coming off a large company plan? Maybe I'm retiring pre-65 when I'm eligible for Medicare. If I have some flexibility there, should I wait a few months to see how all of this plays out before trying to make a switch to an individual plan?
Possibly, because you're going to be, when you leave your employer, you're going to be offered, you can be offered COBRA or Cal COBRA in California, and so you can continue on the group plan at the group rate. And so you just have to make an assessment of the plan compared to what's in the marketplace. You might be better off staying on your COBRA as long as you can. You might be better off getting off COBRA right away and going into the individual marketplace. So you really need to look at it both sides of it to see what's best for you and your family.
Great. One last question coming through here that I think is a good one. One of the items that we haven't touched on yet are the high deductible HSAs. So for people who are currently on those, how will that play into their insurance coverage going forward?
Good question. There are HSA plans under the new metallic levels. Most of them are a bronze level. There may be a couple that are silver, but you won't find anything that's because of the uses a high deductible. Typically, it's going to be a bronze level. But yeah, there are HSA plans both on the individual marketplace and on the group marketplace. So if you're on an HSA qualified plan, you have to be moved to a new plan. You can choose an HSA plan. So it really depends on the market's a little different. What carriers are offering HSA plans has changed some. So you have to kind of look at what's going on. But yeah, you'll be able to continue on with an HSA plan if you want to.
Well, Jim, thank you so much for your time. This has been quite informational. And any questions that we didn't have time to answer during our session together, we will follow up afterwards. Or if you have questions, actually, Jim's email is here, jholtz@pacbell.net. He's happy to answer questions. And this is one in a series of webinars that Mosaic Financial Partners is looking to offer to our clients and partners that we work with. So we look forward to seeing you again in 2014 on future webinars. Thank you very much, Jim.
Thank you much.